So let's get to our question of the day. Has inflation peaked or paused? I want to ask Lori Calvasina, RBC Capital Markets, head of U.S. equity strategy. All right, Lori, from the equity side, peaked or paused?
So look, our economics team has been optimistic that we were going to get some moderation. So I would say that we're in that moderation camp, and that even if we haven't absolutely seen the peaks, that it's still coming and the trend is going to be more favorable going forward.
Okay, a more favorable trend. Good to see you, Laurie. So moderation is how you would describe it. So how do you position for that? What does a portfolio ready for moderation look like?
So look, I will tell you that we have generally tried to strike balance in our portfolio. So we have overweights on the growth side and the value side. On the value side, we still like financials. On the growth side, we've actually, and I'll stress that we're telling people to be very selective here, but we do like the tech sector on a longer term play. And we think if you can sort of get markets more comfortable with the idea that inflation is starting to moderate, and we're certainly starting to see 10-year yields take a little bit of a breather, that should help that tech trade moderate going forward. And I want to stress it's high quality tech, not low quality tech. We still think there's a lot to be nervous about in here, but we would really just strike the idea of balance and frankly not trying to play every little trade in the market.
Fair enough. Let's talk about the value trade for a second, Lori, because Credit Suisse and Bank of America both talked about value and sort of downgrading their value today. And I wonder, where has value become too expensive and where is value still value?
So look, I don't think that value has become too expensive. I think that what's happened is that we've taken the pandemic-related froth out of the growth trade. And so whether we're looking at growth relative to value, or secular growth relative to cyclical or defensive in terms of valuations, a lot of our different valuation models are kind of back to where they were in 2018 or 2019. And when we look at things like financials, energy, materials, they are still quite cheap. Even industrials have moderated in terms of valuation. But what I think we're also starting to see is that parts of the growth trade, so things like technology, things like communication services, things like consumer discretionary, for example, are starting to make a valuation case as well. And I think, when I think about sort of the flip from value to growth, and we actually made this call, about a month or so ago, obviously a bit too early on it, but what we talked about was not just that sort of change in the valuation dynamic, but when you are shifting away from a hot economy and an above average GDP environment back to a below trend economic environment, we do typically see growth sectors take leadership back from cyclical sectors. And I think that's one thing we can all be, kind of pretty clear on right now, that we're moving away from that hot or above average economy back to something that's at a minimum kind of at trend or below trend again.
So from what you've been saying, Laurie, there, you're being quite discerning in terms of, within tech, but also the other sectors that you're thinking about at this point. In terms of the overall market, does it look cheap enough to be buying at these levels?
So we've told people valuations are not at hold your nose and buy levels. Things have not gotten so cheap that you absolutely have to buy the market. But we have noticed, and I think we put this piece out last week, where we said if you look at the recent melee in stocks, that we've really gotten to a point whether you're looking on a trailing PE, which is not in dispute, a current year PE, or a forward year PE, which are in dispute. But all three of those valuation multiples right now have actually cracked the long-term averages. And so, we think that it is fair at this point to start doing some bargain hunting. There are bargains to be had out there. And frankly, the Russell 2000 small caps did that a month ago. We actually saw them go back down slightly below their long-term averages on a forward PE. And that's actually right where you bottomed out at in the pandemic. So if you can get people more comfortable in the fundamental narrative going forward, I think that stocks are cheap enough to buy. Are valuations a reason to buy on their own? No, not yet.
Fair enough. Hey, Lori, talk to me about positioning. You guys do a lot of positioning work on mutual funds and hedge funds and kind of what's owned and what's not. Where are we? Maybe we lost feed. Do we get you? Lori, are you still there?
I'm here. Apologize.
We're still there. Okay, we just lost your picture for a second. Oh, there you are. Okay, that's all right. Work from home. Okay, so tell me where we are in terms of positioning.
The positioning data, if you look at, sort of broad market versus sectors, what I'll tell you in terms of things like sectors, if you look at consumer staples positioning, we just got this data from the hedge fund 13Fs, you're basically back to 3Q 2016 levels. So the sort of favorite defensive sector of hedge funds, consumer staples, is right back to where we were at the end of the industrial earnings recession of 2015, 2016. So I think at that sector level, you look pretty crowded in that particular defensive. Now, if you go back and you look at the broader market and you look at things like AAII net bull bear, retail investors have been in panic territory for quite some time. If you look at the institutional side on the CFTC data, what we're actually starting to see is that the institutions are catching down to retail. So you look at Russell 2000 future positioning, you've been down around financial crisis lows. You've been not quite been there on S&P 500 contracts, but you've been getting pretty darn close in recent weeks. So I think the institutions have just simply had to catch up to the panic that developed on the retail side. And I think that's all very favorable for stocks if you're a longer-term investor and looking out on a 12-month time frame.
Okay, thinking about the longer term then, Laurie, you think it's positive. I mean, things look pretty positive, very short term as well, don't they? Today, stocks doing very nicely, so it feels churlish to take us back to a recession possibility and recession conversation. But what would you be looking for in stocks to tell you that stocks are starting to price in recession? And talk to me about the timing of recessions actually happening and stocks bottoming out.
So look, if you look at where stocks bottom out, it tends to be about 4 to 5 months before the recession is over. And if you go back and you look at the history of how markets trade in recessions, they tend to sell off early. And I'm just thinking about S&P 500 type numbers here. But you tend to sort of see stocks trade down and then kind of make a V in the middle of recession. So the recession is still going on when stocks already start to recover. And if you look at, sort of the amount of declines, the framework that we've used all year has been that we thought that recession, we were not quite in that camp. And we have, sort of said, we think that this is a growth scare that we're in the middle of, where we will see a moderation in growth, but we'll sort of avoid the worst case scenarios. Markets tend to fall about 14 to 20% in those types of environments. And we've come very, very close to that 20%, kind of that outer growth band territory at some of the recent lows we've made in the market. And we quite simply told people, if you broke below 38.50 for any kind of meaningful way, sustained period of time, the market's telling you it's pricing in a recession. And that's a whole other leg of downside. You tend to see about a 32% drop. It's a different environment. But I think the market holding in here this last week or two is telling you that it's not convinced of the recession case yet. And I think it's important to listen to what the market's telling you here.
So, Laurie, to that point, if you went from an inflation scare to a growth scare, what's the next thing?
I think that the next thing to look at is, kind of what does well in that sluggish growth environment. And that's one of the reasons why we did take our preference for value off and shift back over to growth. And again, we want to be very, very selective. But I'll tell you, the things that I'm talking to people a lot about are things like mega cap software stocks. And I can't go into individual names here, but we're not necessarily telling people to go down into the small cap tech stocks, that have losses, that have questions on their balance sheets. We want to be in sort of the safer part of the growth trade. But I do think that you have to sort of go back and look at some of those secular growers over time and figure out which ones actually are secular growers. One of the things we like about the software space is that it is an inflation fighter. It is an efficiency enhancer. It is a tool for corporate America to get through tough times. And if you think that growth is going to moderate and times are going to stay tough, something like the large cap software space makes a lot of sense to us.